Now, we all know that last year, the home prices, nationally rose by, more than 5%, especially in some of the capital cities where the cost of real estate surged quite actively as well. And so, yes, there has been slight moderation in recent months, but, prices across at least these capital cities around Brisbane, Perth, Adelaide, which has been the biggest performance in 2023. And so, where do you think would the prices rise fastest? Hello and welcome to Helpmebuy Property Podcast. This is season 2 and today's discussion point is all about where the markets are going to go or what to look out for in 2024. Now, we all know that, Perth, Adelaide and Brisbane have defied all the interest rate rises in 2023 and the house prices blew typically a lot of economics expectations in 2023. You were hearing people talking about 20% drop in 2023, but let's see if the market can basically defy these expectations again in 2024. Now, before we kick off and go into a lot more detail, let me introduce my co-host, drum rolls, Alex from Hashtag. He's a data scientist. I'll give him the mic to basically introduce himself. Alex, how are you today?
Pretty good, Moxin. Thanks for having me on the podcast.
And can you talk a bit about yourself?
So,
Hashtag, big name.
Sure. So I'm a co-founder of Hashtag Analytics, and I would call myself data scientist because I do work with data a lot for Hashtag. And, through the development of the product, I had to essentially apply data science for the analysis that we do. I come from a corporate background, so I've worked for major bank in Australia before I left it and, co-founded Hashtag. And through that career, I just pretty much realized the importance of data when business decisions are made. So it was in the consulting space where I kind of honed on those skills. All of obviously decision making was supported by data, and I always championed the data-driven approach. And then at some point I realized that, look, yeah, it's great to work for someone, but with all the expertise and the insights I had, it's time to start something of my own. And it's at that time when I also met my co-founder, Matt. So we joined forces together. He comes from a slightly different background, construction and estimation and all that. We're both property investors, so we kind of already meet, I guess, journey in terms of growing our portfolio. And we just started brainstorming, what it is that we can do. And we had our own frameworks in place, both researched market extensively before we made our decisions on our own. And then we thought, well, let's just take all the knowledge that we have and make it public, put it on a platform somewhere. So that's how Hashtag was born. And through, I guess, developing the product over the years, we realized something that's very important, and that's leveraging community of professionals when designing products like ours. So even though it started as just a brainchild of my own and Matt, when we launched the platform, we started getting a lot of feature requests from real estate professionals and investors who signed up or just browsed the portal, found like a suburb dashboard, an LJ dashboard. And like, oh, this is great. You have a chart on this, but I want to see a chart on that as well. So this is where we started taking that feedback, onboarding and developing a platform over the years to what it is essentially now. So it's grown into something that's quite comprehensive. So we do have a data set that we believe is the most sophisticated in the Australian PropTech landscape. There are over 80 metrics that we use in our predictive model, but it's not just the predictive model that we obviously provide, it's also the raw data behind it. So the way the platform is used is that you can combine the output of our predictive model with your own research methodologies, because we make all of the data essentially available to you. This makes sense?
And it's interesting, right? I think, over the last sort of 3 to 5 years, I've seen a lot of companies, playing in this space, naming Hashtag, SQM, DSR in similar way, shape or form, right? And so, yeah, amazing work. And as a data scientist, I always say that, no amount of data is enough, when you are basically doing analysis and you're throwing, more stuff into the predictive and analytical model, right? Or predictive analysis model. And so it's always interesting. Let's start the conversation off and let's kick off the topic. And I want to basically start off macro because, a lot of people go directly into the granular side of, hey, where to buy and what to buy. But I always have this economic joke that always, roams around in my head is, what is the biggest difference between an economist and an old man with Alzheimer's.
What is it?
Economics has a calculator and the guy with Alzheimer's does not. And the reason is, and if you really think about this, right, that I always say this, and this is just a joke, and this isn't me not taking a punt on economics out there, that a lot of economics have, predicted, 9 out of the last 5 recessions, which basically means that they're always on the conservative side and they're always over projecting a lot of these things. And so when you talk about, macroeconomic factors at play, typically from right now, from an economist perspective, there is a few at hand, and, I'll kick off the conversation and you can chip in. From my perspective, when you think about macroeconomic, the first and the foremost where a lot of people are feeling pain is, of course, the cost of living and the interest rate going up, unemployment, and the RBA forecasting the unemployment to go higher. And, typically the borrowing, which is being contracted because of the disposable income available to households, and, that contracted borrowing of about, almost 30%. And so those are some of the key, demand side issues typically, right, which is causing a lot of riff-raff, when it comes to property investment space. What other factors, Alex, do you think are there from an economic perspective that we should take into consideration before taking a deeper dive into what areas to look into?
Sure, you pretty much named them all, in my opinion, based on what you're saying. So yeah, affordability and interest rates are the biggest one. Then we have, I don't think you mentioned immigration, because immigration is pushing some of the markets up. And lastly, obviously, the supply and demand imbalance. So those are 3 things that I think are kind of setting that macroeconomic. But since, we're going to deep dive into the data and, look at individual markets, all those macroeconomic factors trickle down differently in various markets. So it's important to have an understanding of how it trickles down and whether it actually matters when you're comparing markets based on.
Side issues matter. So especially when you talk about, turnover, like, there is less people selling houses right now, or building developments dropping, typically the supply side issues, there is a lot of ambiguity around there as well. While there's a lot of projection around, hey, the interest rate is going to fall or, stagnate over the next 6 to 12 months. But typically the rental crisis and the vacancy rates, all of these play a really big part on the supply side of the equation as well, right? So when you're combining the two together, it's an interesting dilemma. I think you've hit the nail right on the head that, while the macroeconomics indicators stay the same on a macro level, when they trickle down onto LGAs and suburbs or different states, the impacts are quite varied.
Definitely. So we'll go through them one by one. Let's start with interest rates and affordability, right? So, a lot of real estate professionals do CMA analysis. They do comparative analysis of property sales. And we champion a similar approach when you look at property markets. So it's better to compare markets in relative terms than just to look at the broader macroeconomic factors. But when we talk about interest rates are the same countrywide, right? So when you're comparing markets one to another, interest rates have very, little comparative impact on that analysis. But where they do come in is when you look at affordability, because although interest rates are the same throughout the whole country, affordability looks at more things than just interest rates. And it's current median prices or typical prices, the metric that we use, plus household income in that particular market. And I think affordability is one of those macro factors that translates and trickles down to, LGA and suburb level quite different. And I can show you the data later, how it manifests, in different LGAs and so on. We have our own affordability metric that we can talk about, which measures affordability in years, and it ranges significantly depending on where you look at. So the threshold is 30 years because that's the standard assumption we make when we calculate the affordability index because of the, it's a standard mortgage style. And if it's above 30 years, that means that there's challenges in affordability. And if it's below 30 years, that means there's some room left in terms of whether people can afford properties in that market or not. And of course, that's just one of the many metrics that you look at, because here we're talking just about the median revenues and household income in that market. So we don't look at, investor interest, for example, when they're looking in the same markets as well. So it helps to overlay a lot of these different metrics when you trickle down and then come up with a composite analysis of all the data points, and then you have a lot better understanding of how these markets are.
Interesting point here with interest rate, right? While the interest rate remains the same, the way they impact and the way it impacts the disposable income for people is different. typically depending on where they are buying, right? And so ultimately it comes down to the income levels, subsequently to the borrowing capacity, subsequently to the price of the property. And, those are, so should I say, the leading indicators to a lot of the factors that we would be looking at today. There is one important consideration to a lot of these things. Of course, the interest rate drop or rise or any change in the confidence from RBA impacts people's ability to, either go hard and invest more or buy more, or, changing their confidence. But there are these 3 tax cuts that are typically coming about that, the federal government has announced. And so it would be interesting to see as to how does that respond to, towards the property market as well. Of course, the tax cuts are more focused towards the higher end of the market or people with higher income levels, right? And so it would be interesting to see, does that changes the confidence of people basically because they have more disposable income in their hand, or they go out for them to go out and be more aggressive. Of course, combined with, any news of interest rate cuts together with the rate cuts, or interest rate cuts and the tax rate cuts, does that magnify the situation? And so, those are some of the interesting analysis that, I'm keeping a very close eye on as well.
Sure. It's just on the point of tax cuts. Wasn't there a pivot towards the low income earners? Like there was a flip by the government?
Both, right? I think if you look at the tax rate cuts, I think the best ones are basically the low income earners. And then it trickles down to, I think, the mid end where, you still get a good benefit coming out of some of these numbers. So, yeah.
Definitely. There was an analysis done by NZ a while back, and that was before the pivot, and they estimated that tax cut would essentially translate into, it was an equivalent of 2 interest rate cuts. So it would have had the same impact on prices. But I think since they pivoted, then that's like no longer the case. Maybe there's like an impact of 1 or even less.
Definitely.
Equivalent. So
now we all know that last year the home prices, nationally rose by, more than 5%, especially in some of the capital cities where the cost of real estate surged quite actively as well. And so, yes, there has been slight moderation in recent months, but, prices across at least these capital cities around Brisbane, Perth, Adelaide, which has been the biggest performance in 2023. And so where do you think would the prices rise fastest? If I'm talking about much more from a state level perspective, and again, please, for the viewers and listeners, while we are talking about projections, if people should not constitute this as a financial advisor, mortgage advice, or, do your own due diligence, do your own research. Of course, follow data. Don't listen to us, listen to data. Ultimately, evidence-based investing is what we are trying to basically pursue. So if I take you back to the question, Alex, what do you think?
So I'm just interpreting the data. That's how I give most of the answers based on the question, people ask me. And it's actually perfect timing because I pulled up data on search interest on our platform late last week. And just today morning, I published an additional insight on that. So I have an answer for you. So what the search interest highlights is essentially the number of searches on our platform that originate from both the subscribers and the public that, just need to find data for a particular market. And the assumption that we make is that, they've heard about that market elsewhere and just need to look up the data and make sure that, it's a market worth pursuing. And what we're seeing, let's start with the state level trends. We're seeing that there is a bit of a transition happening from Western Australia into Queensland when we look at the search trend data on our portal. But having said that, once you trickle down, you'll see that there's a combination of things that happens at the LG suburb level. Going back to your question, which state will perform the most? In 24, I'm still sitting between 2 chairs, and it's Western Australia versus Queensland. The end of the year would kind of determine, once we have, the close of year data, which one will win. But what we're noticing is definitely transition from Western Australia into Queensland based on investor search interest. And the reason why we use this metric is mainly because it is a great short-term growth indicator. So as you know, investors kind of have this mindset where they always move in packs, and there is like a hype about one state, one area that dies out, and then they start looking elsewhere, especially when, because of that interest, prices start going up and they simply become less attractive to investors. So they shift their gaze elsewhere. I can share a chart with you if you like, and let's talk to that. I'm going to share my screen here a sec. And let me bring up the chart here. So the answer is on the screen. Townsville is the most searched area right now. So that's Townsville LJ on our platform. It just highlights the amount of interest it gets from investors. And the chart is color-coded. So orange is Queensland. I'm not sure that I think it's turquoise color is Western Australia, red is Victoria, and blue is New South Wales. There's search data for other states, but we obviously only highlight the most in-demand markets on this graph. So if you look at this graph, Townsville just beats everything by almost a factor of 2. Next one on the list, second most searched LG is Bunbury. I hope I'm pronouncing it correctly. LG in Western Australia, followed by Mildura and then Rockham fourth. And I prepared this data, I think last week on the season, I spoke to quite a few clients of ours who are researching markets and helping other investor clients. And they confirm essentially that it's really hard to source properties in these markets right now, just because of all the competition that's happening. For example, the other day I was speaking to a gentleman and he said end of last year, they're sourcing properties in Roehampton and was really straightforward and easy, whereas beginning of this year, it's just crazy. So they have to start looking elsewhere.
Yeah. And
so these are the...
This basically, that narrows down a lot of stuff from a search perspective, and we can argue on both sides, right, as to, why and what's happening with Townsville right now. I remember talking about Townsville early in 2021, when it started coming up on our radar, talk about Townsville or Kirwan and, all of these areas around Townsville. Bunbury is an interesting one, especially around Busselton, Bunbury, all the way to Margaret River. Typically, all of those areas are quite an interesting space, to watch out. Seeing Mildura at the top, that's an interesting one for me because, the population growth in Mildura, I haven't seen that growing that fast. And so, seeing there at the top searches, would be interesting to take a bit of a deeper dive and see what's happening in that space. Other than that, I think, we all know what's happening with Western Australia. Typically, around the Mandurah region, and we'll go into a bit more detail when we talk about LGAs or the city of Gosnells and, all of these, pockets, bigger LGAs, the markets have gone crazy. City of, Armadale, city of God, city of Mandurah, etc., all of those areas. So, we'll go into a bit more detail when we talk in terms of area dynamics, but it's very interesting to see as to, there's a massive focus on regional towns versus metro cities, right? You look at majority of these search terms and, they're typically regional towns.
Absolutely.
Like,
so,
you can see that shift happening.
Yep. So to your point, yes, there is the quarterly searches on the platform, but it's also important to explore the dynamics of the searches, whether they're increasing or decreasing. And this other chart that I'm showing on the screen now shows the changing trends as opposed to top search terms on the platform. And interestingly, you pointed out Mildura and you're spot on. Mildura is actually, although it's on top quite high on the list on the first graph, you can see that the search interest is shifting elsewhere. So there's a 0.1%, sorry, just a 0.1 change in search interest in that market. So again, it's really, I call it when I explain this to our investor clients that we're onboarding, it's a bit like, the eye of Sauron in Lord of the Rings. It focuses on one area, and then it grows, and then it looks at elsewhere, and then causes it to grow. But then obviously there are other factors in play. So it's not just investor interest that does impact the house prices. It's also the, socio-economic factors as well as supply demand fundamentals. And those matter well. But since we're taking like a really short-term outlook, so what's going to happen in 2024, this is the best predictor metric to answer that specific question about who's going to come up.
To this also is that, while I do agree that, Perth would still be a strong contender and, parts of Queensland would be, strong contender in 2024, I feel that there are markets which have adjusted backwards, predominantly in Adelaide and core Brisbane, which would be, quite aggressive because I always believe that the market has that muscle memory. And so people who are always looking for premium and they're not chasing growth or they're not chasing yields. And as they see interest rates dropping, their risk appetite would go back into basically going to areas where they'd be comfortable with a 5% yield or a 4% yield because the interest rate, they can see that going to a long-term rate of 4.5%, right? And so that big focus of, I need to get a property that is 6.5% yield or 7% yield would typically shift down towards people being more okay with a slightly smaller yield while trying to be in a much more premium pocket. And so I have big expectations actually from, Metro Brisbane coming back quite strong as well, together with Metro Adelaide. And, if I, plays these states, I would say probably Perth would be a performer still for 2024 because, of course, the affordability is a massive play there. But then the second one would potentially be Adelaide, and then the third one would be Brisbane from a capital city perspective. And so we'll talk about these regional versus metro discussion at the very end. So I'll ask users and listeners to stay till the very end as to, where does this direction go and which is the better one. when it comes to growth and yield. And we'll see some of those charts that Alex would be sharing as well. Let's start off and let's take a bit of a deeper dive and let's kick off on, more granular side of things. And before we basically kick off and, start off with Perth, let's talk a bit about, suburbs versus LGA, because a lot of people don't understand that. A lot of the analysis that a lot of data people would be doing would be typically looking at LGAs, and they would never drop it down to suburbs. They will always, keep majority of this analysis at a slightly high level, or, should I say an SA2 level rather than the suburb level at all. Let's talk a bit about that, Alex, so that, users and listeners can understand why suburb is not a good indicator when you are especially, identifying the growth pockets.
Okay, there's a couple of questions here. Let's start with LGAs and suburbs. So luckily enough, we had, I'm not sure if it should say luckily, but we had COVID, and then everybody learned what LGA stands for, and we don't have to explain to the people what it is. It's essentially a agglomeration of suburbs, and the size of LGAs varies quite significantly across Australia. So the LGAs only have one suburb. For example, Moxin in Sydney is a great example, but then Brisbane City is, I think, like 80 suburbs or something. So when you look at LGA data, the reason why some, data professionals pick LGAs over suburbs is the more sales volume and transaction volume that you can look at when you derive all the statistics for that market. But based on what I just said, the LGAs are very different in terms of size. So in some LGAs, you just look at LGA data and stop, if it's just a couple of suburbs, whereas in other LGAs, you have to deep dive into the suburb data as well. So if I'm looking at Brisbane, we actually, to exemplify this with like the biggest LGA that I think exists in Australia, we actually had to slice it into 5 more markets. So we create artificial LGAs, not south, west, east, and inner. When we look at the Brisbane data, just because there's so many suburbs in there. Now, SA2 and SA4. So SA2 is something that ABS uses when they look at suburb level data. SA2s, essentially they aggregate for SA1 level data, and SA1 level is essentially based on the number of census responses that ABS collects at the street level. And I think the main deciding factor about the number of, the collection points that sit within SA1 is, that is determined by the number of inputs going to the calculation of that metric, so that it does not impact privacy laws. So like when you look at the SA1 data, you want to make sure that you don't reveal anyone's, personal information collected during the census, because if it's too narrow, then, it's easy for anyone to just kind of look at the suburb and then know your address and like, oh, okay, so you'll be, I don't know, your Liberal voter or Labor voter, whatever. You can get all that information for them. So SA2 aggregates the data. So SA2 is a collection of SA1s, but again, because SA1s sit underneath it, it's the whole slicing and dicing of the data is based on the privacy factor. Whereas we're looking at the property market, and the main factor for us is the amount of sales in those markets. So, privacy doesn't really align with the volume sales most of the time. And some SA2s can have multiple suburbs, but then there can also be multiple SA2s in one big suburb. So the split is it's hard to determine. We make things easy, like when we look at the data, let's just look at suburb data because everyone knows what the name of the suburb is. Whereas when you look at SA2, it's, just a number and a letter in front of it. And it makes it harder just people, look at the data and to interpret it. So that's kind of the reason and the reasoning behind why we present the data in this way. We do transform data from SA2 level to suburb level when it's not available. Suburb level for certain metrics, which we collect from ABS, so that, we can connect the two.
And ultimately, all of this comes down to the data reliability, right? So the statistical reliability is basically what you're trying to enforce when you're looking at various different levels. So of course, the more the data is, the more reliability the data brings on the table. So, if there is only 4 data points in a suburb, then of course, the reliability of the data sets and the medians wouldn't work when you're bringing the data together. And that's why, it's important to understand as to what level of granularity are you looking at when you're especially looking at, such huge amount of data available to you. And thank you for sharing that, Alex. I think this is great. Thank you, viewers and listeners, for listening in to Real Estate Outlook for 2024. Stick around because we have 3 more episodes on the same topic. In the second episode, we are going to basically dive deeper into state by state projections, or should I say probabilities, and we're going to start off with Perth. We're going to also talk about how interest rate impacts and influences the market in Perth and regional Perth. We'll also talk about the demand and the supply side of the equations in Perth, and what are the key market indicators, the affordability and the building ratios, and how they're looking at it in Perth. So stay tuned. Please do come back next week and tune in for more state level predictions.